This video lesson covers the material found in General Guidance. In this lesson, we'll learn how to find good stocks to trade by identifying key characteristics. But first, let's break down a typical trading day. The U.S. stock markets open at 9:30 a.m. and close at 4 p.m. every Monday through Friday. Now, there are trades that do take place before and after market hours. However, trading volume during those times are extremely light. During the first hour to an hour and a half of each trading day is when it is typically the most volatile. A lot of trades take place during this time and a lot of money changes hands. But as the trading day gets closer to noon, market volume and volatility tends to slow down. It stays relatively this way until about 3 p.m., the last trading hour of the day. That is when volume begins to progressively increase until the close at 4 p.m. Therefore, with most of the volatility and volume coming into the stock market during the first and last hour of the trading day, it is imperative that you are focused and ready to trade during those times of the day so that you can make the most out of any opportunities that present themselves. Keep in mind that no matter what time of day you find yourself trading, it is absolutely essential that you utilize a 3-to-1 risk-to-reward ratio. That basically means for every cent you risk in a trade, you should expect to make a minimum of 3 times that amount in order for you to warrant executing that trade. Furthermore, it is important to stay true to your exits and never double down on losing positions, as it can cause you to develop very bad trading habits. Now, moving on to how to identify good stocks to trade. We will approach this topic by first identifying a series of stocks that you would not want to trade based on various indicators. We then will identify a good stock by breaking down its positive characteristics. By taking a look at this stock chart, we can easily identify consolidation as the stock trends sideways. New traders tend to get tricked into trading stocks like this one because of the big move that was made earlier in the trading day. It is important, though, to recognize the channel that is formed and avoid entering in either direction until that channel is broken. This will help you avoid very costly churning. Next, we see a stock that has traded very little shares on the day and has a narrow trading range. Both are instant clues that this is not a stock we desire to trade. We prefer stocks that trade in a range no smaller than 75 cents and that have a volume greater than 750,000 shares on the day. Obviously, during the first few hours of the trading day, it can be very difficult to determine if that stock is going to meet that criteria. Therefore, it is important to use the stock's information from the previous trading day. Moving on to the next stock, we see that this too also has really low volume on the day, while also having a very large trading range. When a stock has a trading range greater than 3 to 4 points, it can be difficult to trade as the spread is often wider and risk increases. Next, we see a stock that has only a few limit orders near the current quote price. This instantly lets us know that there is a lack of liquidity, and as a result, there is more likely a lack of action in the stock as well. From this next stock, we see a stock chart filled with white dots instead of green and red bars. This implies a lack of volume and should definitely be avoided. Moving on to this next stock, we see a very large set of limit orders of a few thousand shares on both the bid and ask at almost every single cent. This obviously causes the stock to consolidate and is not something we would want to trade. Moving on to the next stock, we see that this is priced at only $5 and has traded over 35 million shares on the trading day. When these two characteristics unite, it often causes the stock to move very little on the trading day. Therefore, we prefer stocks that are valued over $10 and have volume less than 10 million shares. Next, we see a stock that showcases the other extreme. This stock is high priced and has tiny limit orders which are scarcely placed. Trading something like this can be extremely dangerous because the stock can move quickly and with ease. Next is another high-priced stock which has a very wide spread of 10 cents. This is difficult to trade as risk increases due to the separation between the bid and the ask. we prefer to trade stocks with spreads no wider than 5 to 6 cents. And finally, we see a stock that possesses all the characteristics we prefer. This stock has a range greater than 75 cents on the day, volume greater than 750,000 shares on the day, but less than 10 million shares. The stock price is greater than $10, but also less than $100. The spread is within 5 cents, and the limit orders are not too small and not too big. All these things, along with a great stock chart, make this a prime example of what kind of stock we want to be trading. By identifying the trading stocks with these characteristics, we greatly improve our probability for success.